Hi, do you know you can increase the returns of bearish trades by selling options? Today, Slash Traders will show you how to use the bear call spread screener to find heavily overvalued and downtrending stocks that you can trade high probability and high return bearish options. We'll talk about 4 key points today. 1. What is a bear call spread? 2. What are the key points to profitable bear call spreads? 3. How to use the bear call spread screener to find the best bearish trades. 4. The best bear call spreads right now. Bear call spread works by combining a short call and a long call at different strike prices that expire at the same time. The call spread is profitable if the underlying price goes down before expiration. Let's review the profit analysis of selling and buying call options. We receive a premium when we short a call option. If the underlying price goes down, we make a profit. Although a naked call is easy to execute, if the underlying price goes up, the maximum loss is unlimited. We pay a premium when we long a call option. If the underlying price goes up, we make $100 for every $1 increase. But if the underlying price goes down instead, the value of the call option expires worthless. When we combine a short call and a long call at different strike prices, we create a call spread. Since we want to trade bearish, the strike price of the short call will be lower than the long call. Compare this to a short naked call. A bear call spread can limit the maximum loss if we are wrong about the direction. The return on capital is also higher for the bear call spread. On the other hand, a short naked call has a higher break-even price, leading to a higher probability of profit. Let's look at some key points to trading profitable bear call spreads. When selling call spreads, we have negative delta, so we want the stock price to go down to decay the option value. Then we can buy to close the trade. Delta is the changes to options price with respect to changes in the underlying price. A negative delta trade is profitable when the stock goes down, and the trade loses when the stock price increases. If the stock price stays below the short call strike, we can wait for the options to expire worthless for a profit. The maximum loss of a bear call spread is the width of the call strike prices times 100 and minus the premium collected. The buying power used equals to the maximum loss. So when the call strike's width stays the same, a more negative delta leads to a higher premium, lower maximum loss, and higher returns. Let's look at the two bear call spreads with the same $10 widths. When the short call is at negative 54 delta, the maximum return is 77%. When the short call is at negative 34 delta, the maximum return is 41%. The more negative the delta is, the greater the return on capital. The bear call spread screener uses chart analysis to find overvalued stocks that have a high probability of a downward correction that we can sell bear call spreads to open. We want to find heavily overvalued underlying that have a high probability of going down. The option screener uses fundamental analysis to calculate a fair value of the underlying. Then compare that with the last value to find the potential upside of the stock. When the upside is less than negative 30%, we have a high confidence in a bearish outlook. We also use chart analysis to see whether the underlying is in an uptrend or downtrend. When the trends column turns red and shows downtrend with a number, we know the stock price has been bearish in consecutive days. We also need to avoid ex-dividend date before options expiration. On one hand, ex-dividend date usually lead to rising prices and assignment. On the other hand, if you get assigned, you might need to pay dividends for shorting the stock. Since we are strongly bearish about our trade, we can use negative 50 delta ATM bear call spread to calculate return on capital. This gives us the highest return when we are right and the lowest maximum loss if we are wrong. So we can look at the screener for the best at the money bear call spread ideas. Let's pick the highest probability and high return bear call spread entry points. By combining the information in the upside and trends columns, we can see mRNA, Moderna, is trending down as one of the most overvalued stocks. We can sell a Moderna at the money call spread option that expires in 35 days. If the mRNA stock price does not rise before expiration, we have potential to profit 77% from the trade. Now you know how to use the bear call spread screener to find overstretched and overvalued stocks that are trending downwards. Remember to use the screener often to find the best bearish call spreads to add negative delta in your portfolio to spread out your risks. If you enjoyed my video about trading options, please like and share my videos and subscribe to my channel. Thank you.